All right, guys, we will go ahead and get started. It's 12:02, so some more people might pop on, but good afternoon. Thank you guys all for joining us. My name's Nikki. I am with Old Republic Home Warranty and the 2020 affiliate chair for SRCAR. So we have two awesome speakers for you guys today. We're gonna have them go one at a time because they do have PowerPoints, so that way they can go through those and share their screen with us. And then we will be doing Q&A at the end. So if you can hold your questions till the end and then just type them in the chat, we will try to get through all the questions asked. Also a friendly reminder, if you could please make sure you guys are muted so we don't hear any dogs barking or babies crying or any of that good stuff, that would be greatly appreciated. So we will go ahead and get started. We will have Nicole go first. So Nicole is the partner owner at Financial Accounting Services, and she is going to be talking about taxes, PPP, all that fun stuff. So Nicole, welcome, and I will turn it over to you.
Thank you. I'm going to share my screen. Everyone can hear me well, I'm sure. Okay, so let me make this a little bit bigger and let me know, does that look good?
Small.
Still really small.
All righty, let's try that. Is that good?
Better.
Yeah.
Well, let's try something different then. Share screen here and then go like this.
There you go.
Anybody else having trouble hearing her correctly?
Nope. Good. Okay. Well, I'm going to start because we have 30 minutes. Are we good to go? All right, guys, let me know. Just interrupt me. And for me, questions, Lisa, if you want to throw them in, I'll make sure I end right at 30 minutes. And so just sometimes if something's right on your mind, it works a little bit better. If you just ask the question, it'll lead me in a different tangent, and that's sometimes a good thing. So I'm going to start with the PPP loans. I know that most everyone that applied for them did get them, so that's great. And now we're spending the money, and we kind of forgot that we need to shore this up in either 8 weeks or 24 weeks. Some banks still don't even have the applications out yet, and that's not open. So don't forget that in a couple of weeks here, we're going to have to fill out these applications and then ask for this PPP loan that a lot of us received to be forgiven. So that's going to be really important. If you are self-employed, that means Schedule C, you have not formed a corporation, your form is going to be fairly easy. It's going to be a 3508 easy form. And what we believe, and that's kind of been my stance for the last 6 months here, this is what I believe, this is what we think, this is what we're told, is that basically for self-employed sole proprietors without any employees, it's basically all going to be forgiven. Because what you got is you got 2.5 times, you took your 2019 Schedule C net profit, you divided it by 12, times it by 2.5%. That's the money you got. And so they assume that that is your wages. And so they're going to forgive those. And then also you can throw in rent, utilities, phone, mortgage if you didn't take all that money. So we think for Schedule C sole proprietors, it's going to be fairly simplistic. Now, if you're a S corporation, you have employees, it's going to be a little bit more intense. If the loan is not forgiven, it turns into actually a loan. Interest rates at 1%. Now, if you got the loan before June 5th, June 5th is kind of this weird magical date. You have a 2-year maturity on that loan. If you got the loan after June 5th, you have a 5-year maturity on the loan. That's because, you know, some big wig somewhere passed some law on June 5th to get this extended. Payroll costs, a lot of people ask me what are included for the PPP loan. What are payroll costs? It's gross wages. It's also any type of group health plans that you have, any type of retirement benefits that you're paying as a company into 401k plans, and then your state and local taxes paid by a company. That's not that much, so I wouldn't, get too hung up on that one. And then this is really important because when the PPP loans came out, we originally thought like, hey, there's a planning technique. When we only had 8 weeks, we could look at it, and on week 7, we could tell the owner to take an extra W-2 or a bonus to kind of meet the requirements. That is no longer allowed after June 5th. That law was put in to prevent that abuse, what they determined was abuse. And so what it looks like is they're going to look at your 2019 W-2, what you took, and then that's what you're going to be allowed, or there's a cap for an owner, 8 weeks, or anyone. Basically the cap is if you made over 100 grand. So those are the two caps. 8 weeks, it's 15,000, 24 weeks, it's almost 21,000. So this is where it gets a little confusing with the PPP loan. There are two now dates that we can look back. 8 weeks, if that's known as the covered period, or you can look at a 24-week period, and that's known as the alternative period. So you have these two time frames that you'll want to look at to see what's going to make the most sense for you. For most people, it's a 24-week period because you had 24 weeks to use 8 weeks or 2.5 months of payroll services. And so that's what makes the most sense. Also remember that you need to get your salaries up to 75% of what it was. So if you cut salaries, you need to get it back up there by December 31st. You also need to get your employee count back up there by December 31st. If it's not, then a portion of the PPP isn't going to be forgiven. So this is a big thing to take notes. I have a lot of clients right now that are sending me their profit and loss statements. And right now, if you use PPP money, as it's written right now, you cannot expense that money, what it was used for. So let's pretend like you made 100 grand and you had $25,000 worth of payroll costs and rent and utilities, and that's what you use the PPP money for. You need to add that back into income. You're not able to deduct the money that was used for that you got from PPP that you use for expenses. So that's going to be really important because some clients got 150,000. I'm looking at their profit and loss and they're asking if they can skip their third quarter estimated payment because their income has dropped because of COVID. But once I add back in the PPP grant that they're supposed to be forgiven, now all of a sudden their profit is up. And so that's going to be really, really important to work with your bookkeeper or accountant to make sure that you're properly coding that PPP money so that your profit and loss isn't off. I'm going to touch on the EIDL loans really quickly. I'm not a big fan of the EIDL loans. I don't think that I guess I'm speaking to real estate agents right now, and real estate is doing really well right now. Most of my real estate agents are closing a ton of deals. They've made a ton of money. I guess what we don't know is the future, right? We don't know when this is going to stop, if there's going to be, well, my personal thought, when there's going to be a recession, when that hits. And so a lot of people are hoarding this EIDL loan money. And just remember, I'm not a fan of debt, big Dave Ramsey fan over here. And when you have a crisis and you compound it with debt, it turns into a catastrophe. And so that's why I'm not a fan of the EIDL loans, but a lot of people did get the EIDL loans and they're saving it for, I don't know what's going to happen. And that's a fair statement. So the EIDL loans, those are not grants. Those are actually loans. Interest is 3.75. It's for 30 years. You can defer it for 1 year. And the only portion that's forgiven is those advanced funds that some of us got. It was about $1,000 per employee, up to 10 grand max. So a little bit about the EIDL loans. Lisa, while we're on that, do we have any questions, or whoever's, I guess I could look at my own questions here, but I don't want to screw up
the chat so far, Nicole. No.
Cool. Okay. This stuff is complicated. You see this chart ends at 2010, and as you can see, there are a ton of tax law pages, and so it gets more and more complicated. This is not the year for you to do your own tax return. That's basically what I'm saying here. So there are a bunch of changes that happened in 2018, and then in 2020, we have the CARES Act and all this PPP stuff. So this is the year that you need to be working with an accountant for sure. The first thing I like to point out, in 2018, we had it was kind of the biggest tax haul since Reagan, God bless his soul. And we have these new tax brackets that no one talks about. Why I like to point this out is because I have a lot of clients that say, you know, okay, Nicole, I'm married and this year I'm going to make $326,600 because I want to stay in the 24% tax bracket. I don't want to bump up to the 32% tax bracket. And that's so short-sighted because that's not how taxes work. And so taxes are really work in brackets. So if you're married, your first $20,000 that you make is taxed at 10%. Then from 171,000 to 326,000 is taxed at this 24%. Only the next dollar is taxed at this 32%. So I think it's really important when we're looking at tax brackets to kind of keep that in mind. And for planning purposes, fantastic. I can start a 401k plan. I can put 30,000 in my 401k plan between me and my spouse. So I can save it at this 32% bracket. So I just kind of wanted to explain a little bit about the brackets, because I think that's important to note. We never want to be short-sighted and not make a dollar because we're fearful of giving 32 cents to the government. We want to make that dollar and then think about how we can save or plan that dollar so that it's in the best tax advantage way. So let's talk about the CARES Act that came out, bill on March 19th. $2.2 trillion. I can't even comprehend that in my mind, but basically the government printed a ton of monopoly money, and we're going to be paying for it for the rest of our lifetimes and probably our grandchildren's lifetimes. So with that be said, think about taxes and the fact that today taxes are the lowest we'll ever see again. That's just going to be a norm, because how are we going to climb out of this giant hole that the government has loaned? The only way is to increase taxes. And so just think about that stuff when you're going through your life, that today tax rates are the lowest that we'll probably ever see. We all heard about the stimulus check. Some of us even got the stimulus check. Basically, it was $1,200 per person. If you're married, you got $2,400. Your kids, you got $500 for the kids. A lot of people didn't get that yet. They didn't file on time, things like that. Basically, when you file your 2020 tax return, that will all reconcile out. So if you didn't get those stimuluses, they'll reconcile out on your 2020 tax return. Some other changes for 2020, you can put more into 401k plans. If you're pulling out from your 401k or your IRA, it's called a required minimum distribution, a RMD. That changed from age 70 and a half. You had to start pulling out of your IRA because the IRS doesn't want you to die before paying taxes on your money. So that changed to 72. That's big, because if we do go into the recession, we want to, you don't really want to be pulling your money out of the market while the market's tanking. And so that was a nice change that we saw there. You can also put money into the market now past your age of 70 and a half before you weren't able to. And the big change here, and I know a lot of real estate agents ask me about this. I'm not a fan of this whatsoever. I do not ever advise this. But if you have been affected due to COVID, that doesn't mean I want to buy a bigger house. But if you've been truly affected and you've been laid off, you can now pull out of your retirement plan, your 401k plan, without that 10% federal penalty, and you could spread the taxes over 3 years. And so we never advise that, but sometimes that's a last ditch emergency effort there. And so you do have this new law, which there are some planning opportunities with that. But just remember, that doesn't mean to buy a new, bigger house. That doesn't mean you're affected by COVID. So something nifty in 2018 that came out that's not talked about too much, but it's this 199A deduction. I get super excited about it because as small business owners, which many of us are on this phone call, we are the backbone of the economy. A lot of people that you talk to, especially in our area, are small business owners, and most people work for small business owners. And so this is a way that the government has incentivized and said, good job, hard workers, is giving us this 199A deduction. Basically what it is if you have a company that makes $100,000, you now, and I'm making it very simplistic, but you get a 20% deduction of that on your tax return. So I have a company that makes 100 grand. When it comes to my tax return, I only have to pay taxes on $80,000 of it. And so that's rewarding the business owner for taking the risk and the blood, sweat, and tears that we stay up all night thinking about. That's our 199A deduction. So if you make too much money, of course, we get penalized as making too much money. And so there's kind of the phase outs there. But if you're single and you make under 163,000, you get that 20% deduction of business income. That also can apply to rental properties. And so you can keep that in mind for your real estate investors as well.
Nicole, there is one question in the chat. You said you wanted the questions as they come. So it says, just to confirm, the $1,000 per employee EIDL money can be used without needing to be paid back, but the PPP loan has limitations and needs to either be paid back or forgiven based on how it is used. Is that correct?
The idle money, the 1,000 should be used for employees as well. Should be used for payroll costs as well as the PPP money. It needs to be used for payroll costs. If you're looking at your 24-week period, 60% can be used for payroll costs, but that would also include the $1,000 advance that you got from the idle loan. Is that clear? Clear as mud. Good. Shoot me over another question if you guys have another question on that, because I know it does get really confusing. So let's talk about write-offs. For real estate agents, my real estate peeps, what are the 3 most audited items? It's going to be meals, mileage. Mileage is the biggest one, and entertainment. I like to call it merrymaking because I like 3 M's. It's fun. And so let's talk about entertainment. Now, I inherited, she's not from this area, so I can talk about it, a really large client who's a real estate agent. She owns a bunch of brokerages, and she's being audited all the way back to 2015. And she didn't keep great records. What the IRS agent wants is basically her calendar. And so in order to write off entertainment, it has to be, you have to be able, the burden of proof is on you, the business owner. You have to be able to prove its business purpose and use. Let me give you an example of that as I check my time to make sure I'm still good. Yep, I am. So an example of that is my best friend. We go out to the wineries for the weekend. Maybe we even stop at South Coast and have a massage. Can I write that off? Maybe, if I keep good documentation. So I do her tax return, and I also manage, we have an investment firm here, so we manage about $300,000 of her assets. And so I put in there, I have a calendar with my client, and I also put in there what we talked about. We talked about asset allocation. We talked about risk management. We talked about maybe allocating to a more conservative portfolio because of the times. We talked about a little bit of tax planning. I write all that in there. Actually, I use my iPhone calendar and I talk it in there really quick. There's like a helicopter landing in my parking lot. I talk it in really quick in my calendar, and then I shut it down. And then that gets back updated to, I don't know, the cloud somewhere. Hopefully that never goes down. And if I ever got audited, that would be my documentation that I could write off entertainment. That goes for meals as well as mileage. And so here's a kind of a nice kind of tax diary system. You could also use your you know, I use technology to my benefit. So my real estate agents, you did not drive 40,000 miles on the dot exactly every single year, and that's what you give me for your tax deduction. That drives me crazy. That's your number 1 audited item because that's usually your biggest expense. So keep a diary. I know no one's keeping a mileage log, but there are fun apps called, you know, Mile IQ is one of those apps. It works just like a Fitbit. It tracks all your mileage, and then at night you swipe to the left if it's business, swipe to the right if it's personal. And then you can open it up, and you know, I met Mrs. Smith at the Clark House, and so it is important to have your calendar kind of correspond with your mileage app. And so miles for 2020 is 57.5 cents. So you can either take actual or mileage. And people always ask me what is better, and you have to track it for me to tell you that. I'm not psychic, but what I can tell you is if you drive a Hummer. I don't know why, if you drive a Hummer and you're a real estate agent, that doesn't make sense. But if you do, actual is going to be better because you have high fuel costs. But if you drive a Prius, mileage is probably going to be better for you because your fuel cost and maybe repairs aren't as great. And so if you keep track of both, your accountant can tell you what is better for you.
There's a few questions, Nicole.
Cool.
Okay, so first one is, what age can someone pull from their 401k, and is that only if they are out of work or retired? Do they have to pay it back, and what is the tax rate per $1,000?
So tax rates vary. Remember that tax bracket that I showed you based on how much you earn. So you can pull out of your 401k whenever you want. What I should say is, as long as every employer can put special ramifications on your 401k. If they don't want you to touch that money, they can make it that way. But most employers set up the plan to benefit their employees. So you can usually pull out of your 401k whenever you want, but there'd be penalties and taxes associated in most cases. You could take a loan out where you pay yourself back with a little bit of interest. That is not tax That is not a tax event. But if you pull out of your 401k and you're 20 years old just to buy a new car, then you're going to pay taxes and penalties based on your tax rate. I usually say penalties for California and Fed are 12.5%, and taxes are probably about 25%. So it costs you about 37% to pull out of your 401k. However, if you're unemployed and you're not making any money, your tax rate is going to be a lot lower, and your taxes might be less than your penalties at that point. So it all depends on how much money you make. If you're making a ton of money, don't ever pull out of your 401k, because that doesn't make sense. So you can ask your tax professional or shoot me over your tax return. I can tell you exactly how much it will cost you to pull out money. And you can do that whenever you want.
Okay, the other question is, does the EIDL loan show as a personal debt?
So how we understand it is the SBA has attached it there. No. How we understand it right now, it does not show as a personal debt. It's against your EIN number if you are incorporated. And so we're not seeing it attached to people's Social Security. That being said, a lot of times the fine print, you've personally guaranteed it, or you put up business assets for them to attach to a big piece of equipment or something like that. That's how we're seeing a lot of this language in these SBA loans.
Okay, and then next question. Can you use your 401k for a down payment on a house if you are in your 60s?
Yes, you can. But again, you're going to pay taxes on that. So you can use it. You can pull out of your 401k after 59.5 without paying those penalties. This year is a very unique year because of COVID. They're allowing you to pull out without penalties if you can prove that it's COVID related. You got furloughed, you reduced hours, things like that, which most people can prove that. We would never recommend that though, because when we're going into a crisis, even though I can't explain why, the markets are extremely high right now. Usually in times of crisis, the stock markets are down. We know the stock markets are going down. It has to. A recession has to come because of this. And so we would never want to pull out when your funds are down. That doesn't make any sense. You're selling when they're low. Right now is a unique time. They're really high. Can't explain why. Doesn't make sense. A lot of this doesn't make sense, right? I feel like that's my normal standard crap right now. That's what I say. Okay, good. Are we good, Nikki?
Yeah, that looks like we're caught up on questions.
Sweet. Okay, I just want to throw this out too, because I don't think a lot of people think about this, but basically the different type of health plans that are out there. Now, if you are self-employed, your health insurance is a deduction for you. And then most people want to also deduct their co-payments, their chiropractor. I see people try and throw in their facials. You typically make too much money to deduct that stuff. And so here are 3 different ways that you might be able to deduct those: a health savings account, a health reimbursement arrangement, which if you're self-employed, this is great. I have my email address on the bottom of all these slides. Send me over an email and I can send you more information on that. It's a way that you can deduct medical costs right off of your income. It's pretty fantastic if you're a Schedule C and you're married. Or a flexible savings account. What I say is I really love HSAs. I have a health savings account. I fund it every year. It's just a savings account. It sits in cash because that's what I think is best in case of emergencies. Basically what it is because I had a kid, I was single with a kid, I could put $7,100 in for a family plan. And even if I didn't have any health costs whatsoever, I could deduct $7,100 off my tax return, off my federal tax return. So I'd get a great deduction for that. And then it sits in my account until I need healthcare. Now, I don't have any healthcare costs that I know of, but I know one day I will. And so I use that as a mini little retirement plan to save extra money in for healthcare costs in the future.
There is another question. Can you take out from an old 401k to put a down on primary home or only investment? And what about for land?
Yes, you can. You can take out of a 401k for whatever you want. It doesn't have to be a reason. Now, if it's your before COVID, if it was your primary home, you could take out 10 grand without that penalty, but you'll always pay the tax no matter what. There's no way, unless you're loaning, you're taking out a loan and paying it back. There's no way to pull out of a 401k to buy your home or an investment property without paying taxes, unless you get into really complicated self-directed IRAs, and those are a nightmare. So you'll always pay the tax. on taking out a 401k. And you can take out of a 401k whenever you want. I don't recommend it because I believe you should save for those type of purchases, and 401ks for your retirement, but it's there.
Okay, next question. Is HSA or FSA a use it or lose it?
Yeah, so FSA, I'm not a huge fan. Usually anyone who's self-employed in real estate wouldn't even have an FSA. You'll see like teachers or nurses have FSAs through their work. I don't love it because you have to guess what you think you're going to spend in medical costs. You have to fund it, and then you have to use it or it goes away. And I'm never a fan of like putting money in a savings account and then at the end of the year, if I didn't use it, it disappears. So an FSA is good if you know you have medical costs. Let's say you go to a chiropractor every week and counseling, and you have these 3 prescriptions that you have to get, and you know, okay, I have $3,000 of cost or $2,000 of costs every year, then an FSA could make sense. But you have to be employed a W-2 usually through to get one of those. So that's why I love the HSA. It's a savings account that will be there if you use it or not.
And with FSA, is there still a $500 rollover every year?
It depends on how your plan is written through your employer. So that changes. That depends. It changes employer to employer. Okay. I like talking about home office. I know a lot of real estate agents work, actually, they have an office at their broker, and but many real estate agents, in fact, I would say all real estate agents work from home. And self-employed people, I wake up at 4:30 every morning and I start my research. I start planning my day. That's when I read. That's when I blog and when I look at things. And so I actually, even though I have an office in Temecula, I actually have a home office as well. And why I love that is 2 reasons. One, because I get to deduct a portion of my mortgage, property taxes, utilities, all that. But the second is that I get to start my mileage log when I leave my home base, which is my home office. So that mileage, my 13 miles, or I think it's less than that, 13 minutes from my home to my office is now a write-off, whereas before it wouldn't be if I didn't have a home office. And so if you're not writing off your home office, you should be. Talk to your accountant or hire an accountant for that. Couple more tax planning techniques. Let me peek. I have 4 minutes and 45 seconds. Kids on payroll. This is a really unique, fun thing that I did with my son. And so I get the question, Nicole, how can I write off my kid's football, his gas, his cell phone, all that crap that a kid costs? God, they're so expensive. How can I write that off? And my a great idea is to put your kid on payroll, have them do something. They should be filing, shredding. Maybe they are a cute poster child. Maybe they're in a commercial for you. And you create a job description for them. You can pay your child $12,500 up to $12,500. It is their money. They're earning it. So maybe you invest in a college savings plan or a Roth IRA for them, or put it in a bank account, and then now they pay for their football, they pay for their clothing, they pay for their school book, prom, whatever the hell they cost. It keeps on going. And you get a deduction on your tax return of $12,500. The kids won't pay any federal income tax on that because it's under the exemption amount. And so that's a fun tax planning technique that we specialize in. We do payroll here at Financial Accounting Services. So that's kind of our famous year-end trick to scroll off. If you remember the first slide I showed you with the tax income brackets, that's a really cool way to pop someone in that below that tax bracket. So I never will tell you to go out and buy a Hummer, to spend $1 to save 30 cents. That doesn't make any sense to me. Pocket the 70 cents and give it to the IRS. But if you can put that $1 into your retirement plan, or you can put that $1 into a way that you're already spending the money on your kid, or things like that, now that makes a lot of sense to me. And so kids on payroll is a fun tax planning technique. Real estate agents.
What's the minimum age to put your kid on tax roll?
So if it's your child, there's no labor laws. You can start them. I have people that have been doing it since their kid was 1 year old because they're the model, the Facebook model, things like that. So no age limit on your own child. You can, child labor laws don't apply.
Someone's saying, how would I pay my child? Hourly or 1099?
Not 1099. They will owe self-employment taxes on that. So hourly through a W-2. So you would have to hire a payroll service to do that for you, or you should. No real estate agent should be doing their own payroll. That's a nightmare.
And then somebody else asked, can you do that, I guess, up until the age of 18?
You can even do that past 18. So I have I have an attorney that his kid is going to a very expensive school, and she does do research for him part-time on the weekends. And he pays her school is a lot of money, but he pays her basically $40,000 that she uses for school. So basically he can't write off her school because he makes way too much money. This is a way that he can write off her school by paying her a W-2. He can validate it because research, you can pay up to $600 an hour for research for an attorney firm. So everything's in documentation, and we provide the knowledge so that you can, you know how to document all this. I've gone through a lot of audits on this. No IRS agent ever looks at kids on payroll. But you should have your ducks in a row anyway, just in case. How do I track all this? Well, you need to be using QuickBooks. We love QuickBooks Online. We think it's fantastic. And I'm a big fan of doing what you love to do. And so I took this, it was called The Art of Happiness. And it was an online school through, I forget, Stanford or something like that, that taught, money can't buy happiness, but spending time doing things you love can increase your happiness level. And so I know a lot of my real estate agents are awful at reconciling bank statements. Not one of them's like, yes, I reconciled. Accountants are nerds and we like reconciling. And so hire someone to do your books, basically is what I'm saying. It doesn't make sense unless you love doing it. Don't do your own bookkeeping. We do bookkeeping. There's a lot of bookkeepers out there. Do what you love to do. I'll end on incorporating just really super quick. This is complicated, so email me if you want more information on this. But basically, if I'm looking at a Schedule C, that's a sole proprietor, netting $100,000, married filing joint tax return, they would owe $10,500 to the IRS, $3,000 to California. That's what Nicole calls regular taxes. You would pay an extra $15,000 in that self-employment tax. That's your Social Security and Medicare. And so your total tax due on a Schedule C is $28,500. Now, if you just incorporated, you never pay any money to the IRS. California, you pay 1.5%. It flows to your personal return where you don't pay any self-employment tax. But you do need to go on payroll. You do pay some into self-employment tax. That's where I get these extra fees down here. Basically, when I do the math on $100,000, you would save about $7,500 if you incorporate it in taxes. And then we like to put that into a retirement plan since you're not paying into Social Security and Medicare anymore. But anyway, that is it. I am out of time. Oh, I got to say this. Guys, save 15% into savings account for taxes. A lot of my real estate agents, spend the money, and then when it comes tax time, no one wants to come see me. So save 15%. Hopefully we can do tax planning and get it down to 6 or 7%, and then you can go on a fantastic vacation. But don't spend all your money. Save some for taxes. That's it. That's me.
Perfect. Thank you, Nicole.
You're welcome.
Okay, so next we are going to have Dino, and she's going to go over the ins and outs of 1031 tax exchange. I also want to mention, there is a raffle at the end as well, but you do have to still be online. So just wanted to throw that out there and remind you guys that we are going to do a raffle at the end for everyone that was on today's call, but you do have to be present online in order to win. Okay, so I will go ahead and turn it over to Dina.
Good afternoon, everyone. Nicole, what great information you just shared at the pace of a Gatling gun on fire. I thought I spoke fast, but I'm thinking you were an auctioneer in a prior life. But great information. I'm going to talk about taxes, but from a different perspective, obviously from the real estate side of things. And I have to mirror what Nicole mentioned is the fact that with this whole coronavirus pandemic issue, when it comes to the 1031 world, we did see a dip probably in March and April, but since then it's been a steady climb upward. So we've been very, very busy in the 1031 world. So and you guys, and the reason we're busy is because real estate professionals out there being very busy. Okay, so we're going to talk about 1031s, and I'm going to give you, I have 30 minutes, so that's not a lot of time on this topic, but my goal here today is to give you some information to either cement what you already know, to reinforce it, and or give you some ideas about what this product is and how you can use it as a real estate professional. So what we're going to cover, we're going to go over the taxation rates when it comes to 1031s, what taxes an investor may be faced with. We're going to talk about pros and cons of doing exchanges, because there's always pros and cons of any transaction. I'm going to go over IRC section 1031, holding period, like-kind property. I'm going to take you through the process of the exchange, such as the exchange equation, the timelines, the identification rules, and then what you real estate agents need to be aware of when you're navigating through this with your clients. And then Q&A. So any questions you have, you can put them in the chat box. And like Nicole, if it's something that is a burning question, if you're anything like me, if you don't put it down now, you might forget it. So feel free to put that in the chat box. All right, so let's talk about the tax rates. Well, Nicole talked about the income tax rates, but when an investor goes and sells investment property, there's going to be 4 potential tax rates that they're going to be faced with. Anybody that has investment real estate is depreciating that asset. Now, whether they take it or don't take it, they have to account for it. It's called allowed or allowable. And so if somebody is operating an investment property and they're not taking the depreciation, they should, because they have to account for it. Now, depreciation is a beautiful thing because it's a non-cash expense that lowers your real estate taxable income while you're operating the property. However, when you go to sell the property, it has its own special tax rate. And for real property, it's 25%. And then there's the capital gain tax rates. Now, there are still 2 tax rates right now. There's 15% and 20%. Any taxpayer that's married and has income over $496,601, and I know that sounds like an odd thing, but with the Tax Cuts and Jobs Act, they actually have an increase that comes in every year. So every year we have to remember to increase that number. But if their income is more than $496,601, they're going to be at the 20% tax bracket. If they're a single taxpayer and their income is more than $441,551, they're also going to be at the 20%. Anyone else is going to fall under the 15%. Now, keep in mind, like Nicole talked about a little bit earlier, while you think you're in one bracket, when you sell real estate and you're thinking you're in maybe the 10% bracket, well, that income from that gain could throw you into a completely different tax rate. So be very careful with that. Now there's a net investment income tax. Now, most people go, what is the net investment income tax? Well, that's actually, if I say that's the Obamacare tax, everybody gets that one. So when you have the Obamacare tax, if a taxpayer makes more than $200,000 if they're single, $250,000 if they're married, they're going to be subject to an additional 3.8%. So as you can see, at the federal rate, there are 3 different tax brackets. You've got depreciation recapture, capital gain tax, net investment income tax. We are in the state of California. So right now, the state of California's rates range anywhere from 9.3 to 13.3. That number could be changing. I think there's a bill out there right now. I'm not sure how many real estate investors this is going to impact, but there's additional taxes that may be coming down the pipe for California. Now, California does not have long-term capital gain rate taxes like the federal, so it's ordinary income. So when an investor is selling an investment property, those are the 4 tax rates that they're going to be potentially subject to. So fortunately, we still have 1031 tax deferred exchanges. So that is a vehicle that allows an investor to defer. You're never going to hear me say the words free because there's nothing free about it. It's a tax deferral mechanism. So when somebody's selling investment real estate, they can defer that tax and use that money to go off and buy additional property. So think about if I had to spend $100,000 in taxes to Uncle Sam and Uncle Gavin, that's $100,000 that I'm not putting down on the next property. If I did have that $100,000 to spend, think of it at 75% loan to value. That's another $400,000 worth of property I'm buying because I'm deferring taxes. So it's a really good tool for investors. Now, with every transaction, there's always going to be pros and cons. So the pro of doing 1031s is I get to defer the recapture tax. I get to defer capital gain rates. I get to defer the net investment income tax. And California does comply with the federal code. So I also get to defer any state income tax. Another advantage to the 1031 is I'm building my wealth by preserving equity. What I mean by that is I'm not paying the taxes, okay? So I'm using that money to build my wealth and keep my equity. I can use this code to through leverage. So there are examples where maybe a taxpayer doesn't have much that they owe on the property when they sell, but if they're using leverage, they can buy a lot more real estate when they're doing the exchange. I get to diversify, and we're seeing a lot of that right now. People are diversifying mainly geographically, but they're also diversifying by asset class. So I want you to understand that the 1031 is not just specific to California. It is a federal code, which means anywhere within the United States you can exchange. So basically, it's U.S. property for U.S. property. I cannot exchange foreign property for U.S. property or U.S. property for foreign property. Okay, that does not work under the 1031.
Dino,
another big advantage to the.
Oh, there is
sure.
One. Is there still a rule if you live in the property 2 out of 5 years non-consecutive, you get a capital gain exemption?
Okay, so what you're in that particular question, what you're talking about is you have 2 different tax codes that you're dealing with: the primary residence tax code and the 1031 tax code. So under the primary one tax code, which is called Code 121, you can live in the property 2 out of the last 5 years. It's not necessarily consecutive, but you have to be able to support that 2 out of those 5 years was your primary residence. Okay, so when you're doing something like that, so I'm not sure where you're going with the questions going toward, but if somebody has lived in the property, say for 20 years, and then they converted that property to an investment property, say for 2 years, technically they still qualify for the primary residence tax code. Any gain that they have over the exclusion of 250 or 500, they can then do an exchange under Revenue Procedure 2005-14. So there are ways to utilize your primary residence and deal with the 1031. I'm not really covering that today because I only have 30 minutes, but that's the quick version of it, okay? So you can use these 2 codes together if you plan, which I believe I heard Nicole say, I don't know, a lot of times. Plan, plan, plan. Okay, now here's one of the really big advantages to a 1031 is that as an investor, I may want to exchange, and then ultimately I meet my maker, okay? Well, when my heirs inherit the property, under current tax law, they get a step up in basis. What that means is that there's going to be an assessment to the value of the property at the time of passing. Now, when the heirs inherit the property, they're going to get it. So if the property is valued at $1 million, that's what they're inheriting it at. All the gain that I have been deferring, if I'm the deceased taxpayer, all the gain that I've been deferring throughout the course of my investment is forgiven. It's not passed on to the heirs. So that is a wonderful thing. Now, I'm going to say under current tax law because they were tinkering about getting rid of the step up in basis. And then you might want to take a look at, and this is not a political statement, please don't misunderstand what I'm about to say, but you might want to look at what candidate Biden is proposing because some of this stuff is going to be impacted. Okay, assuming it gets through. Now, with every pro, there's cons. So here's a cons to the exchange. There's certain rules that you have to comply with. Okay, we're going to go through that. One of the downsides to the exchange that people don't really grasp is that your replacement property basis moves with you. So when you sell, pay taxes, and buy, you have a brand new basis in the property. But when you do an exchange, your old basis moves over with you to the new property. So if I'm selling for 500,000, I buy for 500,000 and my basis was 200, my new basis is 200. So there's so you have to understand how that plays out. Again, not a lot of time to go into it today, but just understand that's one of the downsides to an exchange. Lack of liquidity. Why? Any cash I keep, I'm going to pay tax on. So I have to roll it into real property. If I have losses, I want to make sure that I'm going to take those losses at the time of sale, that I can offset those losses against the gain. Very important when you're working with investors to make sure that when they're ready to sell that investment property, that they're not only talking to somebody like me as a qualified intermediary, but they're also consulting their tax advisor, because there are instances where there may be sufficient losses to offset any gain on the sale of that property. And when that's the case, take the losses, don't do the exchange, take your time, get a brand new basis in the property. Okay, so always consult the tax advisor prior to an exchange. Do you think there's a possibility of higher tax rates? I think that's very high. And then it's tax deferred, not tax free. Okay, now there are certain guidelines to the code that have to be complied with in order to meet the Treasury regulations for a 1031. One of the requirements is the property qualification. So basically it is real property that's held for trade or business or for investment. The next basic requirement is going to be, how much do I have to spend? So when you're doing an exchange, there's a formula that you have to comply with in order to try to defer 100% of the gain. So basically, how much do I have to spend? What kind of debt do I have to replace? And I'm going to go through all of that. The next requirement is I have to do this within a certain amount of time. Remember I said those rules and restrictions? Well, here they come. Okay, so I only have a certain amount of time to complete the exchange. I have to finish it within 180 calendar days or my tax filing date, whichever is earlier, and I must identify what I'm going to buy within the first 45 days. And then the next requirement is going to be the identification rules, because I have to properly identify the property or properties I would like to purchase in the exchange. Now, when it comes to property qualifications, one of the questions comes up with, well, how long do I have to hold the property? Because one of the big things in a 1031 is there's absolutely nothing in the code that mandates a specific holding period. It's about the taxpayer's intent. So there's a couple of views that you can take a look at. One is if I've owned the property for 24 months, does that help substantiate that I held the property for investment purposes? And most people say, yeah, that's probably a good time frame. There was a revenue procedure that came out in 2008. It specifically addressed vacation homes and second homes and how they can qualify for exchanges. In that revenue procedure, it said that you had to own the property for 24 months. So that's another indication that maybe 24 months is sufficient. Now, some more aggressive may say at least a year, because if I'm holding something for a year in a day, now I'm falling into the long-term capital gain rates and I'm on 2 tax returns, so that may be sufficient. Here's the thing for you as real estate professionals. It's not your call. It's not my call as a 1031 company. Okay, here's my 158,000 times saying it. I cannot, do not, and will not give tax and or legal advice, okay? So neither should you as real estate professionals. We always go to the professional that's going to defend the client in an audit. And like I say, you will never see me at anybody's audit ever, and hopefully never mine, okay? All right, so when it comes to holding period, don't say, oh yeah, 2 years is good, 1 year is good. We don't know, because we don't know what the intent of that property was when the person acquired it. For example, somebody buys a piece of property, they decide to fix it up. It may take them a year to 2 years to get it done. And their intention was to hold, to fix it and sell it, even though they held it for a year or two and thinking, oh, they're good. Maybe not, because their intent was never to rent it out, okay? It was to basically to fix and flip. Does not qualify for a 1031. Now, when it gets into 1031s, we talk about like kind. Now you can see my very colorful pictures here. I can't tell you, I've been doing this 18 years, and it's amazing how many people still think out there that 1031s, if I sell a single family rental, I must buy a single family rental. Or if I sell raw land, I have to buy raw land. That's not the case. So here's an easy way to look at it. It's property that's held for trade or business, or property that's investment real estate, okay? That's the key, not the fact that it's a shopping center going into an office building going into an industrial building, vineyards going into an apartment complex. It doesn't matter. It's investment real estate or real estate that I held for my trade or business. So just know that like kind in a 1031 is very, very broad. Now, let's go to the next requirement about an exchange. Remember I told you there's 4 guidelines. When a taxpayer is doing an exchange, they need to buy property that's equal to or greater than their sale price. They need to spend all of the cash. So here's an example. If a taxpayer sells a property for $900,000, they buy a new property for $1.2 million. They go out, the loan that they paid off at the time of closing was $300,000. They acquire a new loan of $660,000. You're going to have some closing costs. We're going to address that in a minute. The cash coming into the exchange is $540,000. In my example here, it shows that I spent all of my cash and I acquired property greater than what I sold for. This is also a good example of how people use leverage to buy more. Okay, now I'll have a new depreciation schedule on that delta, okay, of the 900 to the 1200 to the 1.2. So again, more is always good in a 1031. And I always like to say to real estate professionals, and your commissions are higher too. So this is an example of when you think you have no boot. Now, I'm going to be clear. There's more likely than not, and probably on 95% of the transaction, there's always going to be some level of boot on that closing statement, but it's not an all or nothing system. That's the key. Okay, just to understand that. Now, here's an example of doing what's called a partial exchange. You can do a partial exchange. It is totally okay. It's not an all or nothing system. So if, for example, I sell for 900,000, I decide I want to buy for only 700, I get a new loan of 300, I end up keeping about 140,000 in cash, I will pay tax on the 140,000. Now, here's what I always recommend folks when they're considering doing a partial exchange is consult your tax advisor to make sure that you're still benefiting from the exchange. So for example, if my boot, so if you hear the term boot, and I'm sure you've all heard it, but boot means taxable. That's all it means. It's the taxable portion of an exchange. There are two types of boot, mortgage boot and cash boot. So my example here is showing you cash boot. So that means money not coming into the exchange. If my boot is either equal to or greater than my actual sale on the property, then there's absolutely no reason for me to do an exchange. I am going to pay the tax as though I did nothing. Any gain that is above my boot, then I'm benefiting because I'm deferring the tax on that portion. So you can do partial exchanges. It's just very important to make sure that your clients are talking to their tax advisor. Now, here's something to be very careful of as real estate professionals. Sometimes people get caught up. I'm sold for 900, they're buying for $1.1 million, they're good to go. Well, in this example here, they received a loan of 700,000. They only had to put 400,000 in cash, which means they did not spend all of their cash. The requirement to an exchange is that you must spend all of the cash. Any cash you keep, you will have to pay tax on. So you cannot get a larger loan and keep cash and not have a taxable impact on that. Keep that in mind. So watch what your clients are doing when they're out there applying for these loans on the replacement property side of the exchange. Now, it doesn't mean that they can't use those excess funds to go out and buy more property, because they can. All right, so let's now talk about what is exchange expenses and what are not considered exchange expenses. Your commissions, the title insurance premium, closing costs, legal fees, notary fees, transfer fees, recording fees, the qualified intermediaries fees, basically any fees that are necessary to transfer the property to the buyer. Now, fees that you might see in a transaction that are not considered exchange expenses, prorated rents and security deposits, points, prepayment penalties. Those are cost of the loan, not a cost of transferring the property. Prorated rents and security deposits are a cost of operating the property, not transferring the property. Paying the buyer's closing costs, we see that often. Lender policy, impounds, taxes, insurance. Okay, all these costs are not considered exchange expenses and will be, potentially taxable to the amount of gain recognized on these amounts. So just be aware that when your client is, when your client's not sure about what they're going to be doing, that they're consulting their tax advisor so they can take a look at that closing statement to say, yes, this is going to be a taxable event, but maybe I can offset this somewhere else. Okay, so just understand that there's certain expenses that are acceptable and some that are not.
There is a question.
Now,
it says, there is
sure.
one question on that. So it says, if I act as my own broker, what's the maximum commission I can charge myself to balloon the exchange expenses to avoid cash boot?
Okay, so the answer to that would be talk to your accountant, but however, all right, but what basically, I would think anything that is reasonable, but understand your commissions are going to be taxed at your income. So you want to just make sure that, if you're keeping a commission, if you're the broker, then you've got it from that perspective. If you're the agent working with the broker, then you're dealing with the broker side of things, but that commission is now your income. Okay, so there are times where real estate professionals that are doing their own deal may want to, you know, collect a commission. That's fine as long as it's acceptable. But so I think just the fact that I said that it's now ordinary income will probably keep you within the parameters of the, you know, of the norm. So I think if you're putting a 20% commission, that's probably outside of the norm and would be very suspect at an audit. So just be careful of something like that. Something that's just customary, I think, is probably the best way to say it.
One more question. It says, what happens if a person moves back into the house, then sells it 3 years later?
Oh, how many years later?
3.
Okay, that's a complicated question. Okay, it gets really complicated because what's happened is in 2009, they changed the rules, okay? When somebody moved back into a property that was part of an exchange, all right, there's a couple of things that happen. One, before you even qualify for the primary residence tax code, you have to own the property for a full 5 years. Okay, so if you exchange that property, then you subsequently move into the property, convert it to your primary residence. Before you even qualify for the primary residence tax code, you have to own it for a full 5 years. All right, so let's just say you've met that criteria. And so you rented it out for 2, you live in it for 3. When you go to sell the property, you're going to have a reduction of the primary residence exclusion to the number of years that it was a rental to the number of total years of ownership. So basically, in an example of a 2-year rental, 2/5 of your exclusion are going to be reduced. So you don't get the full 250 or 500,000. Okay. Now, if you had it as an investment for 2 years, moved in it for 2 years, and then moved back out of it, converted it back as an investment property, then you would be able to get the full 250 or 500,000. Now, you always have to pay the recapture. That doesn't go away. That's a tax that's going to always be there. Okay. So so you have to watch your timing in and out of these things when you're converting rentals to residents and residents to rentals. All right. Okay, now, when you're dealing with an exchange transaction, there's certain contract language that you have. All right, some of you might use the SES form, the Seller's Exchange Supplement. You can use the blank lines on the RPA. I always at this point say whatever your broker tells you they want you to do. Okay, doesn't matter to us, but you have to have 1031 cooperation language in there. Now, a lot of times folks go, why? Why does that have to happen? Because you can't just have anybody assigned into a contract without people cooperating. Okay, so for example, if Nikki and I happen to be in a transaction together, you know, and then I saw all of a sudden have somebody else coming in taking over my position, Nikki has to agree to that. She has to cooperate with assignment of that contract. In an exchange, the contract gets assigned to the qualified intermediary. You have to have a 1031 company in an exchange or you do not have an exchange. So that's the whole reason for the contract language, because we step in the shoes of the seller and we technically become the seller of the property. We, however, do not physically go untitled to the property, not in a forward exchange. Okay, but this is a requirement for the 1031. And there's this thing called direct deeding. That's why we don't have to go on title. When they're buying the replacement property, we have to be assigned into that as well. Now, I know they're working on the CAR document, the RPAs. I don't know if they're completed with it or not. I'm not sure. I haven't kept up on that recently. But under the current RPA that I'm familiar with, the buyer cannot assign the contract. So you want to make sure when you're working with buyers doing exchanges and you're using the CAR's RPA that you're putting the 1031 language in there when you're buying, when they're making offers on the property, because we have to be able to be assigned into that contract. All right. Now, here's steps that you need to take when you're dealing with an investor. Always have your client talk to their tax advisor. And this is where I always keep my fingers crossed, okay, that they have a good, competent tax advisor that understands real estate, because that's the person that has to be able to interpret what that client is doing. Have them talk to the qualified intermediary. We're going to have 2 separate conversations. I'm going to be talking about the 1031, what they're going to expect, and then with the timelines and everything. Confirm who the taxpayer is. You're going, well, what do you mean by that? I can't tell you how many transactions that I have seen where you guys are getting the, you're looking at the title report and you're going, oh, that's the taxpayer, that's the person that actually owns the property. Well, you know, you've got Jill Smith and John Jones that were on title to this property. They're not married to each other. And you're thinking, okay, they own it by themselves. Well, they forgot to tell you that J&J created an LLC 3 years ago, started to file it as a partnership, but never bothered to change title. Guess what's going to happen when they walk in my world? You got to fix title. You got to fix the PSA, because when you're doing an exchange, while you're involved in a real estate transaction, you are now doing a tax transaction. So the taxpayer, so who's my taxpayer that owns the property? And this comes up often. So when you guys are out there taking listings and you're seeing the title, you know, if it's a husband and wife, you're probably not going to have that big of an issue. But when they're the non-related individuals, you definitely want to make sure who's the taxpayer. Okay, how are you reporting this on your tax returns? And if they don't know, again, back to item number 1, talk to the tax advisor. And then confirm that the purchase agreement does match the tax ownership. It smooths out the escrow process. All right. You've done all this, you get into escrow, the exchange accommodator, we have to get involved prior to the escrow closing. Because we have to get assigned into the contract. In order for us to prepare our exchange documents, we have to get information from escrow, such as the purchase and sale agreement, prelim, and escrow instructions. From there, we prepare the exchange agreement along with the wiring instructions. Your client has to sign it. We wait for the closing to take place. When the buyer brings in their funds, the deed is going to go directly to the new buyer. Again, direct deeding. The money is coming to the qualified intermediary. That starts the time frame in the exchange. So this is when the clock begins. At the close of escrow. This is when the 180 days and the 45 days begin. These are statutory timeframes. They are not subjective. They have not left to be interpreted. Okay. The minute escrow closes, that starts the clock. Now, there were some extensions recently, but I can tell you we're in August. Those extensions do not come into play. That ended on July 15th. So there are no extensions at this time. Now, with all the fires we're dealing with in California, maybe there's some new extensions coming out. I have not heard of them yet, but when that time comes, we as a qualified intermediary, at least our company, notify the clients, and then they go to talk to their tax advisor to see if they're able to take advantage of any extensions. Okay, and I'm going to come back to the identification period in a minute. You go out and they find the replacement property. We prepare the exchange agreements for that. When they get ready to wire, we're going to wire our funds in. The client's going to get the funds in coming from the lender, and then that's the cycle of the exchange. And I'm going like really fast because I'm running out of time here. Okay. All right. So that's the flow of the exchange. So let's talk about the hard part to the exchange, because the hard part is going to be the 45-day identification period. And I want to stress that when I talk about 45 days, I am not talking about business days. It's calendar days. So weekends count. So when you're dealing with the identification period, that's the hard part to the exchange. Now, candidly, most people are not going to be filling out the ID form itself until they get closer to the 45th day. Okay. Now, when they ask about, well, how many properties can I identify? Well, there are 3 rules. They only get to choose one of the 3. The most commonly used rule is the 3 property rule. So you're physically limited to 3 addresses, but you're not limited to dollar amount. So if I sell for $500,000, I can identify a property for 6. I can identify a property for 650. I can identify a property for $1 million. And buy whichever one of those 3 I want, buy 2 of them or buy all 3 if I chose to. But if I want to identify 4 or more, now I default to the next rule, which is the 200% rule. Under the 200% rule, I can identify 4 or more. But I have to watch the dollar amounts for each and every one of those properties, because it cannot exceed 200% of my sale price. So using the $500,000 example, if I identify 5 properties and I add them up, they can't be more than $1 million, so 200% of the sale price. So there are times when people go, well, I'd like to identify 10 properties. I'm going, where are you selling and where are you buying? So if somebody is buying in Beverly Hills and they're going to buy their replacement properties in single family homes in Alabama, in Ohio, in Michigan, Florida, then they could very well likely use the 200% rule because they're usually selling for a very high price and they're buying, the properties they're buying are a lot smaller value. So we see folks that are exiting California a lot, that may be selling somewhere in the $500,000 range, and they're going to buy properties that they can buy for $150,000. They can easily use the 200% rule comfortably. Okay. Now, if they identify 4 more properties and the values exceed 200%, now they're in the third and final rule, the 95% rule, which means basically unlimited properties, unlimited dollar amount. But before you get excited, you have to understand they have to close on 95% of the total value of all the properties they've identified. So in effect, they have to buy their entire list. That is not a rule you ever go toward, because that you can end up losing your entire exchange if you do it wrong, okay? So have to be very careful as to what the client is doing. Now, when we talk about identifying, I just want to be clear, I like to say there's the technical and the practical. The technical means your client will be filling out a piece of paper, giving us the address, city, and state of the property that they're identifying. They do not have to be under contract with any of those properties. However, they can only purchase the properties that are on the list. So from a practical standpoint, they should be under contract with a property or properties. Okay, very hard part to the exchange. I tell people, keep your eyes on the prize, because the next 45 days, your life is going to be focused on real estate. Okay. All right. So things to watch out for as, as real estate professionals, title versus taxpayer. Do we have the right people? Question that comes up, where do I get the earnest money deposit when they're buying the replacement property? Well, if we as a qualified intermediary are holding funds, then those funds can be used for the earnest money deposit. Now, I always tell real estate professionals at this point, if your client's going to be using earnest money deposit, the exchange proceeds for the earnest money deposit, change that time to bring it in from 3 business days to 5 business days. Okay, because there are certain things that have to be done before we're able to even wire the funds. So we first of all have to know that your client's in contract with the property. We have to get a copy of the fully executed purchase and sale agreement, and we have to know the name and contact information for the escrow officer handling the purchase escrow. From there, we prepare the replacement property exchange documents, the request for funds form. Your client signs it, then we can set it up for wiring. Okay, so just be aware that there's rules that we must comply with to keep the integrity of your client's exchange at play, okay? All right, next thing, who initiates the exchange? The burden technically is on the party doing the exchange, which should be your client. But as real estate professionals, you definitely want to make sure that they're keeping their eye on the prize, okay, that they're doing what they need to be doing. All right. So it's up to the client doing the exchange. That's their responsibility. But I think as professionals, it's important that you maybe, guide them through the process. All right. Make sure that they've got it done. G6 restrictions. When I talk about G6 restrictions, this is a very, very important part to the 1031 code, because we can only use those funds to purchase the replacement property. So there's times where we've had in situations where a client is buying a replacement property and the lender's saying, okay, I'll fund the loan for the replacement property, but you need to pay off that car loan at the same time, okay, that you're funding. Now the people didn't have any funds, so they go, oh, well, I'll use exchange proceeds to pay off the car loan. Not going to happen. Okay, that car loan is not buying the replacement property. That would be a violation of the G6 restrictions, which would invalidate the entire exchange. Okay, or could potentially invalidate the entire exchange. So there are rules that when you're dealing with accommodators, if we start sounding like Mother Superior, it's because we're again trying to protect the integrity of the client's exchange. This one's very important. Who fills out the identification form? Not you. Okay, I've had real estate agents that have filled out their client's ID form. Now, and when they sent it in by midnight of the 45th day, which happened to fall on a Sunday. So Monday, the ID comes in. There's nothing you can do to alter that list after it's past the 45th day. The agent filled out the list. English was not the client's first language. And she had 2 clients doing exchanges at the same time and put the wrong properties on the wrong ID forms for the clients. Now that's a heck of a problem because nothing can get altered after the 45th day. You do not fill out the list. Okay, I cannot express that enough. I think it's important you make sure that they have the right addresses on there, because I've seen that happen too, where the client's putting in the wrong address and you guys are making offers on something else. So I would say verify, but do not fill out the list, okay? Current situations that we're seeing, people are fixing up properties before sale. They go, can I get reimbursed for that? The answer to that is not without it being a taxable event. It doesn't mean that it can't get offset, but you're not going to be getting reimbursed for the fix-up cost prior to a sale without it potentially being taxable. We're seeing a lot of people buying multiple replacement properties and starting to see a little uptick on people selling multiple properties to consolidate. Went over the G6 restrictions, partial exchanges I discussed, reverse exchanges. Do not head there blindly, okay? A reverse exchange, as I like to say, is not for the weak of wallet, because when they're doing a reverse exchange, it means they must close on the purchase before they have closed on the sale. So the question is, where are they getting the money to buy the property? So if you find yourself in a situation like that with your client, call a qualified intermediary immediately to go over the reverse exchange, because they are very expensive exchanges. And if there is a lender involved, depending on who the lender is, more likely than not, that exchange is not going to be able to go through, because we physically now go untitled to the property. So just be careful of reverse exchanges. And so in conclusion here, just to watch out for, if you are working with investors, okay, you tell them about a 1031. You never tell them they should or must do one. You do not know, but you need to let them know that they have the potential to do a 1031, okay? You want to be aware, make them aware of the product. Make sure that the purchase agreements are signed by all the sellers. That's, I know, strange, but it does happen. If your client is doing an exchange and you're not the one that's helping initiate the exchange, then make sure that the client has actually set up the exchange. I can't tell you how many times agents go, well, I told my client about an exchange, and the client's going, well, I told my agent I wanted to do an exchange and nobody's done anything. All right, so just make sure that if your client's doing an exchange, that they have actually set up the exchange. And then totally stay away from giving tax advice. No shoulds, you must, you need tos. Okay, very dangerous language as a real estate professional. I have 14 years as a commercial broker, so I know your world, okay, from a little different perspective. So that's my rapid fire 1031 information. Okay, hopefully it was helpful today.
Awesome, thank you. All right, so do we have any last minute questions? I definitely want to thank both Dino and Nicole for being on here today. You guys both gave a lot of great information that I know was a benefit to all of us. So if anyone has any last minute questions, either put them in the chat or unmute yourself. Otherwise, we'll go ahead and do the raffle and then we will end it. So any last minute questions? Going once.
Hi, it's Mary Landcamp. Is there any possibility of getting this slide presentation?
For the 1031? Yes.
Yes.
Yeah, for 1031, yeah. Just, I'll give you, my email address is Dino, D-I-N-O, at apiexchange.com. Just email me. I'd be more than happy to share that. I'll put it in the chat
Okay,
box.
could you just put that in the chat?
I'm going to do that right now.
Thank you.
Can you tell me how you guys get paid? You get paid out of the transaction, and what should a client expect to pay in fees for a capital gains company?
Oh, for a 1031 company? Okay,
Yes.
Here's my standard line. We're the least expensive thing that saves the most amount of money. So exchanges range anywhere from, every company is a little bit different. I've seen some as low as $600 to up to $1,000. Accommodators fees are flat fees, okay? So it comes out of the exchange proceeds. So most accommodators, we collect our fee once we have their funds, all right? But it is a flat fee. It's not a percentage of sale.
Up to $1,000.
Yeah. Mm-hmm.
Thank you.
You're welcome.
Any other questions? Okay, both of them both Dino and Nicole did put their emails in the chat. So make sure you do jot those down if you want to get information from them prior to the meeting ending, because otherwise the chat will disappear. Okay, if there's not any other questions, Wendy, are you ready to spin the wheel? So we have a raffle prize. It's donated by myself at Old Republic. There's a Starbucks gift card, a coffee mug, and some goodies. It is at SRCAR Marietta location, so the winner is welcome to pick it up during their hours of operation. Carol Rounsley, are you still on the call? I'm looking through. There's a lot of people I'm looking through. Carol, if you're on, unmute yourself and let us know that you are here. I don't see her. Wendy, do you see her?
No, I don't think she's on. She's not here.
Okay.
Moving on to the next.
All right, next one. Christy, I think I just saw Christy still on.
Is Christy here?
Yeah, she's there. I see her. Okay, so Christy, you can pick up your prize at the Marietta SRCAR location. So
Thank
again,
you, Nikki.
you're welcome. But again, thank you to both of our presenters and to everyone that joined us today. A lot of great information.
Thank you.
And again, grab their information over here on the side before we sign off, and you can reach out to them with any other questions or needing the slideshow. So that is it. Thank you guys. Have a great day.
Thanks for having us.
Thanks for coming, guys. Have a great day.